Starting a business is exciting. It's a journey filled with dreams, aspirations, and the thrill of creating something new. The initial phase is often marked by a burst of energy and enthusiasm, where every small achievement feels like a giant leap forward. It's about bringing a vision to life. You gather your team, brainstorm ideas, and start laying down the foundation of what you hope will be a successful venture. The excitement is palpable as you see your ideas taking shape, transforming from mere thoughts into tangible plans. But let's be real, it takes fuel to launch a rocket. Just like a rocket needs fuel to break free from gravity, your startup needs resources to get off the ground. This is where the reality of business sets in, and you realize that passion alone isn't enough. That fuel is cold, hard cash. Money is the lifeblood of any business. It allows you to hire talent, develop products, market your services, and keep the lights on. Without sufficient funds, even the most brilliant ideas can wither away. Fundraising is how you get it. The process of securing funds is crucial. It involves presenting your vision to potential investors, convincing them of your startup's potential, and negotiating terms that will benefit both parties. It's a skill that every entrepreneur must master. Fundraising isn't just about getting money. It's about building relationships. When you bring investors on board, you're not just gaining financial support, you're also gaining partners who are invested in your success. It's about finding partners who believe in your dream. These investors share your vision and are willing to support you through the ups and downs. They become your allies, offering not just money but also their expertise and connections. These partners, investors, bring more than money to the table. They bring experience, networks, and guidance. Their insights can help you avoid common pitfalls and navigate the complex landscape of running a business. They bring experience, networks, and guidance. Their advice can be invaluable, helping you make informed decisions and steering your startup in the right direction. Their networks can open doors to new opportunities, partnerships, and markets. Think of fundraising like dating. It's a process of getting to know each other, understanding each other's goals, and determining if there's a mutual fit. Just as you wouldn't rush into a relationship, you shouldn't rush into a partnership with an investor. You wouldn't marry the first person you meet, right? The same principle applies here. Take your time to evaluate potential investors, understand their expectations, and ensure that their vision aligns with yours. The same goes for investors. They are also evaluating you, assessing your business model, your team, and your potential for growth. It's a two-way street, and both parties need to feel confident in the partnership. You need to find the right fit for your business. The right investor can make a significant difference, providing not just capital but also strategic support and mentorship. They can help you scale your business and achieve your long-term goals. This essay is your guide to the world of fundraising. We'll explore the different stages of fundraising, from seed funding to series rounds, and provide you with practical tips and strategies to attract the right investors. We'll break it down so you can navigate this world with confidence. Understanding the nuances of fundraising can empower you to make better decisions and position your startup for success. Get ready to fuel your startup's journey. With the right knowledge and preparation, you can secure the funding you need and build a thriving business. Let's embark on this exciting journey together. Before you even think about approaching investors, you need to know your numbers. This means having a solid understanding of your financials. How much money do you need to get your business off the ground? Don't just guesstimate. Create a detailed financial plan. This plan should include your projected income, expenses, and cash flow. Think about it like this. You wouldn't go on a road trip without knowing how much gas you need, right? Your financial plan is your roadmap to fundraising success. Bootstrapping means starting your business with your own money. This could be savings, credit cards, or loans from friends and family. Bootstrapping is tough, but it has its advantages. You maintain complete control of your company. You answer to no one but yourself. Think of it like building a house yourself. It takes longer and requires more effort, but you have the satisfaction of knowing you did it your way. Angel investors are individuals who invest their own money in startups. Venture capitalists, or VCs, are firms that invest other people's money. Angels typically invest smaller amounts in earlier stage companies. VCs, on the other hand, invest larger amounts in later stage companies with high growth potential. Choosing the right investor is crucial. It's like choosing a business partner. You need to make sure your goals and values align. Crowdfunding has exploded in popularity. It's a way to raise money from a large group of people, typically online. There are different types of crowdfunding, such as donation-based, equity-based, and rewards-based. Each platform has its own set of rules and regulations. Crowdfunding can be a great way to validate your idea and get early customers. However, it takes a lot of work to create and manage a successful campaign. Section 6. Loans and other debt financing. Weighing the costs. Taking out a loan is another way to finance your business. Loans can provide the necessary funds to start or expand your business, purchase equipment, or cover operational costs. This could be a traditional bank loan, which typically involves borrowing a lump sum of money that you agree to pay back over a set period with interest. Alternatively, you might consider a small business administration loan, which is partially guaranteed by the government and often comes with more favorable terms for small business owners. Another option is a line of credit, which allows you to borrow up to a certain limit and only pay interest on the amount you actually use. This can be particularly useful for managing cash flow and covering short-term expenses. Debt financing can be a good option if you need a large amount of capital quickly. It can help you seize opportunities that require immediate funding, such as purchasing inventory at a discount or expanding your operations to meet increased demand. However, you'll need a solid business plan and good credit history to qualify. Lenders want to see that you have a clear strategy for how you will use the funds and a track record of managing your finances responsibly. Remember, taking on debt means taking on risk. If your business doesn't generate enough revenue to cover your loan payments, you could find yourself in financial trouble. It's important to carefully consider whether the potential benefits of taking on debt outweigh the risks. Make sure you understand the terms of the loan before you sign on the dotted line. This includes the interest rate, repayment schedule, and any fees or penalties for late payments. Consulting with a financial advisor can help you make an informed decision and ensure that you're choosing the best financing option for your business. Additionally, consider the long-term impact of taking on debt. While it can provide immediate financial relief, it also means committing to regular payments that could affect your cash flow and limit your ability to invest in other areas of your business. It's also worth exploring alternative financing options, such as equity financing, where you raise capital by selling shares of your business. This can be a way to secure funding without taking on debt, but it also means giving up a portion of ownership and control. Ultimately, the decision to take on debt should be based on a thorough analysis of your business's financial situation and growth prospects. Weigh the costs and benefits carefully, and don't hesitate to seek professional advice to help you navigate this important decision. With careful planning and consideration, debt financing can be a powerful tool to help your business grow and succeed, but it's crucial to approach it with a clear understanding of the responsibilities and risks involved. By weighing the costs and making informed decisions, you can ensure that you're taking the right steps to secure your business's financial future. Section 7. Strategic partnerships, collaboration for growth. Strategic partnerships can be a valuable source of funding and growth. This involves partnering with another company that has complementary products or services. For example, a software company might partner with a hardware company to offer a bundled solution. Strategic partnerships can give you access to new markets, customers, and resources. Think of it as a win-win situation for both companies involved. Section 8. Crafting your pitch, telling a story that sells. Your pitch is your opportunity to sell your vision to investors. It's the moment where you can capture their imagination and make them believe in your dream as much as you do. This is your chance to stand out from the crowd and make a lasting impression. It's not just about the numbers, it's about telling a compelling story. Numbers can show potential, but a story can create a connection. Investors want to know the journey, the challenges, and the triumphs. They want to feel the passion behind the project. Your pitch should be clear, concise, and persuasive. It should be structured in a way that flows naturally, guiding the investors through your vision. Start with a strong opening that grabs attention, followed by a well-organized body that covers all key points, and end with a powerful closing that leaves a lasting impression. It should answer the following questions. What problem are you solving? Clearly define the problem in a way that resonates with the investors. Make them understand the significance and urgency of the issue. How are you solving it differently? Highlight your unique approach and innovative solutions. Show how your method stands out from the competition and why it's the best way to address the problem. Why are you the right team to do it? Showcase your team's expertise, experience, and passion. Investors need to trust that you have the right people to execute the plan successfully. Practice your pitch until it's second nature. Rehearse in front of a mirror with your team and in front of a test audience. The more you practice, the more confident and natural you will appear. Remember, you're not just pitching your business, you're pitching yourself. Your passion, dedication, and belief in your vision are what will ultimately convince investors to come on board. Make sure your enthusiasm shines through in every word and gesture. Engage with your audience, make eye contact, and be responsive to their reactions. Show that you are not only knowledgeable but also approachable and open to feedback. Building a rapport with your investors can make a significant difference. Be prepared to answer questions and provide detailed explanations. Anticipate potential concerns and have well-thought-out responses ready. This demonstrates your thorough understanding of your business and your preparedness to tackle any challenges. Finally, celebrate your successes, no matter how small. Each pitch is a learning experience and a step closer to achieving your goals. Stay motivated, keep refining your story, and continue to sell your vision with passion and confidence. Section 9, the long game: building relationships for the win. Fundraising is not a one-time event, it's an ongoing process. It's about building relationships with investors over time. Attend industry events, network with other entrepreneurs, follow up with investors, even if they initially say no. Remember, investors are people too. They invest in people they like and trust. So get out there, build relationships, and watch your fundraising efforts soar.